Good afternoon, everyone, and welcome to this month's webinar entitled The End. Today's presentation will last about 50 minutes. During that time, if you have questions as we go along, feel free to ask them on screen, and we'll do our best to answer them as we go along. And then we'll take some verbal questions at the end if there's time. The webinar is, as always, being recorded, and we'll post it to our website within about a week. Regarding CFP-CEs, if you are logged into the webinar today for more than 50 minutes using the email address you registered with, we'll report your attendance to the CFP board, and that can take up to about a month. If you've joined us on our 2013 webinars, you know that we've followed one couple, Sam and Sally, through their lives, reviewing the different types of insurance needed during each stage. Thank you for joining us through the journey. This month, sadly, Sam and Sally will go through a lot: disability, needing long-term care, and finally, death. We'll focus on their needs during those times and on the importance of beneficiary designations that result in what the insured actually desires. And now about your presenters. Mark Maurer is a CFP and an MBA who's constantly monitoring the insurance and financial services industries. Under his leadership, LLIS continues to expand its portfolio of products and services. He's a member of the National Association of Insurance and Financial Advisors and a frequent speaker for NAPFA, ACA, Garrett Planning Network, and other organizations seeking insurance-related education. As of January this year, he is the CEO and president of LLIS. Judith Maurer is the founder of LLIS, setting new industry standards with a full range of insurance support services that feature web-based quote requests and fast response times. Judith based her business model on the principle that her client is the advisor rather than the end user, and that LLIS is an extension of a fee-only financial practice with the advisor an intricate part of the insurance planning process. Since 1998, she's expanded the products available and hired specialists in each line. To start us off today, please welcome Judith Maurer.
Good afternoon. This is Judith Maurer. It's exciting to be with you. This time of the year, we know everybody's very busy with end-of-the-year planning, and in our situation, the end of life and of the policy. So we're going to talk a little bit about Sam and Sally. We watched them start their career way back in January. We saw them build a business and build their family. We saw them retire and enjoy a very active lifestyle. And now they have reached the end of their life. We're going to talk about the end. We're going to talk about claims that have to do with disability insurance, long-term care insurance, life insurance, and annuities, and how those claims processes work. As Dina mentioned, I've been in this business a long time, and I'm starting to see claims on business, and so it's been an interesting learning experience for all of us to go through these with many of your clients. So we'll start first with disability. Our Sam and Sally both had disabilities, but they were very different. Sam's disability occurred when he was age 42, and it was only a 2-year claim. Sally's, on the other hand, started at age 55 and lasted for the rest of her life. Let's talk about Sam first, his 2-year claim. Sam was riding his brother's motorcycle, came around a corner and ran into a truck. He was injured severely, and he had multiple breaks in both of his legs, which required lots of surgery. So his advisor called us and said, you know, Sam has had this happen. What should we do? The first thing one should do is notify the insurance company. Years ago, it used to be that agents did this on behalf of clients, but unfortunately now, insurance companies want to deal directly with the claimant. So we suggested that Sam call the insurance company right away. Even if there might not be a claim right then, don't wait. Let the insurance company know that there might be a claim. Then if there is a claim, the insurance company will send claim forms to the insured. And as you can imagine, it's a lot of paperwork, but necessary part of the process. Those claims forms then are submitted to the insurance company, and they are assigned to a claims analyst or a professional claims manager. Once that business is taken care of at the insurance company and reviewed by the professional there at the insurance company, then they will require a personal visit. And this is an unscheduled visit, essentially to evaluate the client's condition to see if they really are indeed disabled. It requires periodic validation. The insurance company may call the client's doctor just to make sure they're still unable to work, or they may send someone in person to visit, or they may simply order medical records. There's a number of different ways that a claim can be checked up on. In this case, Sam had a 2-year injury claim. His injury occurred on January 3rd, and it's 2014, so it hasn't occurred yet. It's a 90-day elimination period. So he becomes benefit eligible April 2nd, which is 90 days after he became eligible because of his injury. His first check then was received on May 1st, and he started receiving his checks every first of the month after that. Checks are always electronic funds transfer for disability, so they went right into his checking account. Sam was very diligent about his physical therapy. He worked hard. He had to have multiple surgeries, but he returned to work 2 years later, and his last check was received on April 1st, 2016. Sally's situation was much different. Unfortunately, at age 54, Sally was diagnosed with multiple sclerosis. And after only 1 year, her condition deteriorated so that she was unable to work. So the insurance company was notified. Just like with disability insurance, you should notify the insurance company right away. Even if you don't submit a claim right away, you should still notify the insurance company and describe the claim and what's happened, what makes it a claim. The insurance company, much like disability insurance, will assign the claim to a claims analyst, and there's a process that's completed by the insurance company where they obtain medical records, financial information. They may contact her employer, and in this case, because she was still working, that's exactly what they did. They also made a personal visit, and they have the ability to request an exam. Now, because of her diagnosis, she had extensive medical records, so that would not be needed. But for someone where there wasn't a long, multiple medical records, an exam could be required. She was benefit eligible after 90 days of not working. That was her disability claim, and so she was then approved for her disability benefits. Her monthly checks were deposited until she became Social Security eligible at age 65. The insurance company, again, does validate that claim by either ordering medical records or requiring a personal visit. This one went smoothly. But what happens if claims are not paid? Well, first of all, claims are sometimes not paid with the first application. And if that occurs, the claimant will be notified in writing by the insurance company. They'll get a letter that explains the reason for the decline or the denial, and then it will also give that claimant steps for appeal, how they go about it. Second, if someone appeals to the insurance company repeatedly and doesn't receive the information they expect or the approval they expect, they can always go to a state insurance department and request a assistance with applying for that claim. It's been our experience that state insurance department is kind of a last resort because insurance companies normally really do try to approve claims for disability. The state insurance department can nudge them along if it's needed. Why would someone be declined? They would be denied a claim. It would be likely incomplete medical records, for example, or insufficient proof of the inability to work. So they might go back to the client's employer and check to see if they really are coming to work, or if they're simply not able to work. Or on psychological issues, documentation can sometimes lag because psychiatrists are very reluctant to release medical records, and insurance companies have to have them in order to validate. Lots of people think that you're denied automatically the first time for a claim. I think that may be truer for claims for Social Security disability payments. It has not been in our experience that it has not been the case with insurance companies here, certainly not with the ones that we work with. Lawyers are a last resort in our view, and it's been our experience that do-overs don't work, or do work. Anytime someone has a claim that is denied, almost always simply fulfilling the things that are missing in the appeal will get that claim approved. It's very interesting to note that recent long-term disability claim statistics say that $9.4 billion are paid long-term disability claims payments have increased that much to people. 43% of new claims approved were for individuals younger than age 50. 57% of new claims were for individuals age 50 or older. 54% of new claims were for women, and 12% of new claims were for pregnancy and childbirth. And this may also, if you've had clients go through underwriting recently, this may also tell you why that women in childbearing ages actually pay a little more for their disability insurance, simply because of the increased likelihood of claims. Some other interesting statistics are the common causes of claims. This may not be a surprise to anybody, but it's interesting. 30%, 30.7% are for things related to the musculoskeletal system, backs, muscles, joints, and connective tissue disorders. Examples of connective tissue disorders are fibromyalgia, scleroderma, rheumatoid arthritis, systemic lupus, and vasculitis. 14% are them for diseases of the nervous system or spine, 12% for the circulatory system, 9% for cancer, and 34% for other. And included in that other, of course, are mental and nervous disorders, which prevent someone from being able to work. Currently, in 2012, 8.8 million people were on claim, which is 5% of the workforce. The economic costs of becoming disabled are high, aren't they? All right, let's talk about long-term care claims. Sam and Sally's lives have gone on. Sally's MS was such that she couldn't work, and when she retired at age, or when she stopped being paid her disability benefits at age 65, she then received Social Security. And Sam is caring for Sally. She's done pretty well up until the time that they decide to move into an assisted living facility. Sam is now 78 and Sally is 75. Sam's remarkably healthy. He goes out for lunch. He cares for Sally. But as time has gone on, her health has continued to be affected by her MS. So now at age 75, she's no longer able to do, she's now not able to do 2 out of the 6 activities of daily living. So she and Sam notify the insurance company that there's likely to be a claim in the near future. At this time, the insurance company, the long-term care company, will assign a personal visit to her from a nurse or a social worker to see how she's doing. And they do a little bit of an evaluation of the situation. And that's the way they can confirm that she has indeed qualified for her benefits. There will also be, of course, a medical record documentation. Once she is declared eligible, the process simply means you can't do 2 of the 6 of the activities of daily living, or, of course, if you have a cognitive disorder. Once this claims is reviewed, then the professional at the insurance company declares Sally benefits eligible. It's important for you to note that, because just because you call the insurance company and say you're ready doesn't mean you've been declared benefits eligible until there's this review. That's when the elimination period starts. So you may be benefits eligible, receiving services, and paying for services yourself. And at that point, we also recommend that you continue to pay your long-term care premiums, because once that benefit eligible time is determined, then the insurance company likely reimburses you for the time that you've been paying yourself after the 90 days has completed. So here's how payments actually work. In this case, Sam has hired caregivers to help take care of Sally. They're in an assisted living facility, so it's easy to add this service onto their services that they receive. So the payments are paid directly to Sam and Sally, or the Sam and Sally pay the caregivers directly. They're paid directly by the policyholder. Then the insurance company reimburses Sam and Sally for the expenses that they have incurred paying for their caregivers. That money is deposited in a checking account, usually by an automatic bank transfer. Occasionally, insurance companies will allow a check to be sent directly to the policyholders, but they definitely prefer to use an automatic deposit. It is paid, the other way they can do it is to pay directly, the caregiver can be paid directly by the insurer. It simply depends on the policy, the insurance company, and the policy features. They can be paid directly by the insurance, but only if the policyholder assigns the benefits with a form for electronic deposit or check to be paid directly to the caregiver. Again, timing is important on long-term care claims. Reimbursement is paid after services are received and the month is complete. For example, let's say that Sally receives care during the month of September. Then Sally, if she's able, or Sam in this case, will make copies of the itemized service invoices and submit them at the end of September or the 1st of October. The reimbursement check will be deposited then late in October or early November. It's important to pay attention to the dates. One of our employees here at Low Load Insurance Services, parents are on claim, and they were having a terrible time figuring out the cycle for payment. And it turned out that simply they were saving all of their receipts and sending them in the very last day of the month. And so it would take a long time for those receipts to be reviewed. So they sometimes didn't make the check cycle for the reimbursement, and it would often take 6 to 8 weeks instead of the normal 4 weeks to get reimbursement. Now they've figured out the system that the insurance company uses for reimbursement, and everything is going smoothly for them. So pay attention to the dates. The insurance company will be happy to tell you when they cut checks. So they want to do this correctly. We also recommend that the policyholders label all of their correspondence with their name, their claim number or policy number, or both. Sometimes long-term care companies, the claim number is the same as the policy number, but not always. So if you put the client's name, the claimant's name, and the policy number and the claim number on the correspondence, it's much easier for the insurance company to match that to the correct person. Claims are reviewed, and also there is a continued eligibility confirmation, and certainly the claim forms themselves are likely to indicate the person is continuing to receive care. So how did it work out for Sam and Sally with their long-term care? Sally needed a caregiver to help her bathe and transfer and get settled for the day, and the independent care provider came to help her manage that and manage her medications. What did this do for Sam? Well, Sam, because he lives in the assisted living facility, has lots of opportunities for social things, to get out a little bit. And he was able to go to a movie once a week, and he was also still able to participate in his Romeo Club. Some of you may be wondering what Romeo stands for. It stands for Retired Old Men Eating Out. It gave him a respite for the intensity of caring for Sally, and all is well in their lives until the end. So I would like to turn this program over to Mark now, who's going to talk about life insurance claims.
Thank you, Judith, and thank you all for tuning in today here in December. And I had one advisor ask a question: can you expound a bit on the mental issues that can impact disability? And that's a very broad spectrum there. It's the disability benefit is paid out if you're unable to perform the material and substantial duties of your occupation due to injury or illness or whatever it might be. So depression, anxiety, stress, bipolar, there are lots of things that obviously can cause a disability, but particularly stress, anxiety, depression are things that someone may have not had in the past, and because of some outside influence has gotten to where they go on a claim. All right, so let's talk about life insurance claims, where we were talking a little bit about with the disability and long-term care, there's a process. At least the process for life insurance on the qualifying is, are you breathing or not? It's sort of a yes or no type question. So Sally has had the disability benefits, she's had her long-term care benefits, and Sally dies at age 84 with a $250,000 policy in force. Sam, as the beneficiary and spouse, calls the insurance company, may call you as a financial advisor, may call the agent, Low Load Insurance Services, because he found that in the policy, with the letter there. So any of those are good people to at least start the initial, what do we do next? Well, sort of like with the other policies, the claim then is really handled between Sam and the insurance company directly. You may be able to get Sam in touch with us, and we may be able to give Sam the phone number for the claims department at ABC Insurance Company, and but at that point it's really between the beneficiary of the policy and the insurance company. The insurance company is going to mail the claims package to the beneficiary. In that package, they'll be required to provide the name of the insured, of course, the date of death, certified copy of death certificate. Many times they ask for a return of the policy if it's available. If not, a lost policy form just that says, I know we get these annual statements, I just can't find the actual policy. If it's a survivorship policy, in this case, Sam's still alive, but if it was a second to die or survivorship policy, it's still important to go ahead and send that death certificate to the insurance company, letting them know that one of the two insureds has already passed away. Many times, older policies may have a waiver of cost of insurance at a first death, or either a benefit that happens at a first death. If nothing else, they've already got that Sally is deceased in the system, so then when Sam's information comes along, kids or somebody else aren't trying to scramble and find Sally's information from years ago. With life insurance, the payment is usually made within 30 or 60 days of all of that information being processed at the insurance company. Interesting, the interest is paid from the date of death. So if someone, for some reason, finds a policy 2 years later and didn't realize that there was this policy, the beneficiary can fill out all the forms, and that $250,000 policy may be $270,000 in proceeds because there were 2, 4, 5 years of interest due on that $250,000. One thing to note is that the interest is taxable, where the $250,000 in this example, the death benefit, is income tax-free. There are options for receipt of proceeds, wire transfer, again, probably preferable for larger policies, a single check simply mailed to the client, or a checkbook. And most insurance companies and most people who have a claim like the idea of the checkbook. Basically, with the benefits package, that's really what it is. It's a checkbook that allows the beneficiary to start writing checks right away. Maybe $1 million. If I got $1 million and somebody said, "How would you like that?" I don't know, but I do know that I have $10,000 of funeral expenses coming due. I do know that I have $15,000 at United because we flew grandkids in, and $5,000 for putting everybody up in a hotel. Hey, the checkbook works really well to be able to pay those little things, and then 3 months later, 6 months later, when I get to meet with you, my financial advisor, and say, okay, I have about $1 million left. What do we do with that? So you're not having to make big decisions on what to do right away. Now, we've taken care of everything with Sally. Now Sam dies at the ripe old age of 96. And Sam had 2 different life insurance policies. He had a $500,000 GUL, or guaranteed UL, policy. Who the primary beneficiary of that policy was Sally. He wanted to make sure that she was taken care of if he died predeceased her. And policy B is a $500,000 survivorship GUL. GUL just means it's a no-lapse guarantee policy that they set up so that that policy was going to be guaranteed to their age 120, 121, their lifetimes. So those are policies that are designed to be in force when they die, whenever that is. Well, remember, Sam is male, and where women tend to outlive us males, we tend to go first. And so the original plan was that Sam was going to die first. But Sam had quite a bit of longevity in his family, and Sally, because of her issues, passed away at age 84. So the primary beneficiary of policy A was Sally. That was sort of her policy. If something happened to him first, he wanted her to have cash. And then we had a contingent beneficiaries. If the primary beneficiary is no longer alive, then the contingent beneficiaries are, who I'd like to have the money next, my kids. Policy B, because it was a second to die policy on Sally and Sam, they can't be the beneficiaries of that policy. They were the insureds. And so the policy B was then the primary beneficiaries were the kids. And so even that's a way that with the contingent beneficiaries, even though it didn't work out exactly as we'd planned, being able to have contingent beneficiaries and some of the contractual language of life insurance creates a great Plan B or Plan C sort of contingency. Now, that's because Sam didn't do anything when Sally died. He forgot about the policy, what have you. The policy took care of it sort of automatically by itself, but he could have done some things differently. Sally was gone, so he obviously can take her off as a beneficiary of the policy. He could have changed the primary beneficiary to his 2 children, and then the contingent beneficiary to his 5 grandchildren. Things that we can do if our primary beneficiary predeceases us. Maybe his primary beneficiary would have been his 2 kids, and then he could have had a contingent beneficiary of the synagogue preschool. Lots of things that as a contract you can do where had any of those things been through a will, through a trust, we have attorneys, we have attorney fees, attorney costs, having to talk to an attorney, all those other things where with changing the beneficiary of a life insurance contract, easy and no cost. Policy B, again, it was set up that the kids would be the beneficiaries. The kids are still alive. No changes needed. We talked about the claim statistics, but again, these are just very large numbers. They're interesting. They show the value to your clients if something happens to a spouse, a parent. $58 billion paid to life insurance beneficiaries in 2012, and over $70 billion paid in annuity payments. That's money that's coming back into your clients' pockets, your clients' children's pockets. And so all of those are the wealth transfer that we're seeing as the boomers get older. Now, what happens when beneficiary designations go wrong? Sounds a little bit like a Hallmark movie of the week, but not quite as exciting as that. I don't have any scary music, nothing darker. So we have, what's the problem number one? We see this relatively frequently, is people may name, I'd name my wife as my primary beneficiary, and I'd name my 2 children as the contingent beneficiaries. The problem with that is we have Misty Michelle Doe, my kids are 4 and 6. The problem is that if something happened to me and my wife, there would be a beneficiary designation of my 4 and 6-year-old. Now, insurance company is not going to pay my 4 and 6-year-old money from a life insurance policy. Just not going to happen. They can't enter contracts. I don't know if they know how, they can't really sign their names very well. All kinds of problems. Judith's over there laughing. So what's the right way to do it? Something different, really. You can name a trustee. So if there's a trust, name a trust as a contingent beneficiary. A potential guardian would be a good person. Or simply the estate under my will. Hopefully you have those people with small children have a will. And so just naming the estate under my will, there's an executor of the estate named. There are lots of things. Really what happens in this case would be the benefits would go into probate. It would go to court. Court would need to decide who could be an executor. Lots of things are held up. And so if you're a guardian and all of a sudden you have 2 new children, you prefer to have money sooner than later. Question, should the trust be named as a beneficiary or the trustee as an individual? Normally both. You would normally name the trust, the Mark W. Maurer Revocable Trust, comma, Judith Maurer Trustee. And so definitely name the trust as the first thing, but usually then also who would be able to act for the trust. A poorly worded trust name, family trust. Okay, well, what if the client's been divorced? Maybe he has 2 family trusts, one for my first family, one for my second family. So the $1 million, or let's make it fun, my $100 million goes to my family trust. Which one? Again, being specific and clear makes a lot of difference. The Howard Yakamoto, trustee of the Glenn and Mary Doe Family Trust, dated June 15, 2008. There's no, that's clear. There can't really be any confusion on which trust. Now, we've had Judy Freeman, who works here in our office, used to do a lot of claims for an insurance company before we were lucky enough to have her come work for us. And they had a death claim, a client who named a trust. Well, this trust wasn't just poorly worded. The trust didn't exist. The named beneficiary, the only beneficiary was a trust, and it had a name. It was not like family trust, but it had names. But they'd never finalized a trust, never signed it, never gotten it finished. So here's the problem. Obviously, that we're going to have problems. This went through years of probate, went through years of attorneys, attorney fees that eventually come out from all the family. Because the trust was never established, the insurance company eventually paid the estate instead of the trust. Again, the trust didn't exist, but it'd never been finalized, but the trust had specifics about how he wanted to leave money to certain people, certain entities. But because it was never finalized, even though that was the insured's wishes and desires of how he wanted to disperse his assets at death, It was too late because it wasn't finalized. It wasn't a valid entity, regardless of being able to read through what had been started and the intent. It wasn't finalized. Multiple beneficiaries. Now, this can be a problem. Nephews and nieces, Joe, Misty, and Marie. Insurance companies want a percentage of the beneficiaries and not a dollar amount. And remember, because of the interest, or people can take loans, they can take withdrawals, they may not be able to pay $100,000 on a $300,000 policy because because of loans. So percentages would be much preferable. Naming each one specifically, and also being able to provide a date of birth and a social security number, last name, all of these things. Now, may not be a problem too much if all are alive, if it's not the best, but what if one of Misty, Joe, or Marie happened to be predeceased, or predeceased the other two, and predeceased the insured? There's additional ways you can set up the definition of beneficiaries. Does it pass per capita, per stirpes? Those really go into more in-depth of should, let's say, Joe predeceases the insured and Misty and Marie. I could set it up then that Misty and Marie then become 50% beneficiaries. I could set it up that Joe's 34% passes to his children, and Misty and Marie still get their 33%. Again, lots of things we can do, but we can't do anything about them once the insured is dead. No way to change those. Problem number 4, let's name my spouse as a beneficiary. I name my spouse. The right way is to name Mary E. Doe, spouse, with her date of birth and social security number. Well, naming spouse when I took out my policy in 1972 may not be the same spouse I'm married to in 2013. For me, I wasn't married in 1972, but I have the same spouse. But about 50% of first marriages end in divorce, and about 75% of divorced people will remarry. This is from a 2011 study. Basically, naming spouse doesn't cut it. You need a name, and you can change that. The nice thing about beneficiaries, they're easily changeable, but have to set it up right the first time. Children as beneficiaries. Again, I'd like to name my children equally. Well, better is to name the two children, their dates of birth, social security number, and give the actual percentages. Let's see what happens when we talk about children equally. Remember, 50% of marriages end in divorce, and 75% of those divorced people marry again. Well, we have Mr. and Mrs. Smith, and they are one of those couples, called the Brady Bunch syndrome. He has 2 kids from a prior marriage, and she has 1 child from previous marriage, and they get together. And so they are talking to their attorney, who happens to be a family friend, and they say, how do we want to disperse assets if something happens to you? Well, they both use that less than helpful equally. And to Mr. Smith, he said, her son, my stepson, is, I think of him like, or think of her like my own, and so I would like everything to go equally, a third, and a third. Remember, equally isn't exactly a clear word. She said, I agree, it should go equally. Half to my daughter and the other half to his 2 kids. Now, we have the same word equal meaning 2 very different things to 2 people. If anyone wanted to guess how this situation got resolved, you got it. Another divorce. So now they are both divorced twice. So something like equally doesn't help. So what are the costs of beneficiary designations going wrong? Well, possibly divorce, as we just saw, but assuming it's not that complicated, there's time. Naming minor children, there's just time before a claim can be paid to a guardian, to the rightful person, or somebody who's going to care for the children, because they can't pay the person the first time. Costs, there are attorney's fees, there are probate fees. There's family harmony. I name all my children. You've read about stories where there are children that people didn't know existed, and all of a sudden, things are being split 4 ways instead of 3 ways. So those are the costs of beneficiary designations gone wrong. Now, I'd also like to talk about annuity claims. If a client has a deferred annuity, meaning one that they aren't already receiving income from, there's a contractual beneficiary at death, and the annuity value is passed there. When someone receives an annuity, they can receive the cost basis or sum of premiums paid, income tax-free, and then any gains in the policy over and above the cost basis would be taxed as ordinary income to the beneficiaries. There's no step-up in cost basis with an annuity, unlike life insurance. And again, with annuity, it may be called a death benefit, but there's no step-up in cost basis. On a deferred annuity, both a spousal beneficiary or a non-spouse beneficiary can receive that annuity and cash it out in a lump sum. They can disperse all of the values over 5 years, paying any taxes due, or take equal and substantial payments over their lifetime. A spouse, though, can continue a deferred annuity on as his or her own, and just change the name as the owner and continue the deferral for their lifetime. A non-spouse beneficiary doesn't have that option, or else people could continue annuities on indefinitely and never pay any taxes. And so those first 3 are available to non-spouse beneficiaries, very similar to IRA, inheriting IRAs. So Sam passes away with 2 deferred annuities and leaves both to Sam Jr. Now, annuity 1, the cash value is $100,000 and the cost basis is $75,000. He paid a $75,000 paid $75,000 for this annuity a number of years ago. Sam Jr. At Sam's death, Sam Jr. gets $100,000, but owes ordinary income tax on $25,000 of that. So if he surrenders it, he gets $25,000, owes taxes on $25,000. If he decides to take it out in over 5 years, withdrawals out of annuity are earnings out first. So if he did it just evenly, he'd take $20,000, owe taxes on 100% of that. The next $20,000, he'd owe 5%, owe taxes on $5,000, and the rest of it would be cost basis. Then cost basis, cost basis, cost basis. If he chose to annuitize it over his lifetime, then he would have an exclusion ratio and pay a portion of each payment would be considered income tax-free return of premium, and a portion of each payment would be those gains taxed at ordinary income. Sam also had a second annuity with an enhanced death benefit rider. Now, had the same cost basis, same cash value, same policy, but this one he's paying for an enhanced death benefit rider, so the death benefit is actually $150,000. Now, it's called a death benefit, but it's not tax-free like life insurance. So if Sam gets $150,000, he still owes taxes. He still gets $75,000 income tax-free, but everything over and above that is taxed as ordinary income. Now, if I'm Sam Jr., I like option 2 better than option 1 because $150,000 if I'm paying more taxes is better than a stick in the eye, but it's not an income tax-free death benefit like life insurance. So that was deferred annuities, annuities that are just sitting and accumulating, not already in the annuitization phase. Let's look at immediate annuities. And Sam has 4 immediate annuities, all paying $1,000 per month and all funded with $100,000 purchased at different points in time. But nice round numbers to illustrate my example. His first one he purchased was $1,000 per month, and it was a life-only single premium immediate annuity. So benefits continue for as long as he lives. At his death, benefits stop. If they pay for 2 months or 400 months, benefits continue. A period certain annuity pays a specific amount for a specified period of time. So in a 10-year period certain, there will be $1,000 a month for 10 years. When Sam dies after receiving 8 years of payments, then the remaining 2 years of payments go to his named beneficiary, completing the 10 years. So even though he died, it will pay for 10 years to Sam, then Sally, to Sam, then Sally, and Sam Jr., 10 years. No longer, no less. $1,000 a month, and this is a lifetime payment with an installment refund. So it will pay for the longer of his lifetime or until his $100,000 single premium has been paid out in installments. So Sam dies after receiving $80,000 in payments. $1,000 per month continues to beneficiary for 20 more months. So $80,000 went to Sam, $20,000 went to his beneficiaries. The $100,000 that were paid in has been paid out. $1,000 a month, and this is a life with a cash refund. Very similar to the above, except that instead of getting the $20,000 over 20 months at $1,000 per month, Sam received $80,000 and his beneficiaries receive a lump sum of $20,000, again, completing the $100,000 minimum payout. And we have questions from advisors sometimes about what are sort of the protections of insurance for my clients, myself, as I'm looking at insurance companies. Well, for insurance companies to operate in a state, there are state insurance regulators, and they are looking at each insurance company and making sure that they have adequate risk-based capital standards. They have strict investment guidelines on how much can be in any one particular asset, the type of assets that an insurance company can hold. Most of it must be in high-grade debt. So, even there's limitations on what can and can't be in an insurance company's general account portfolio. They have regular on-site financial examinations. There are actuarial reviews of the company's actuarial practices, how many people are truly getting the preferred plus. Does that make sense? Accounting reviews of the financials behind the underwriting, and agent licensing regulations. States require all of us who are licensed agents to have take ethics courses, not unlike the CFP ethics courses, hours, education, things like that. There's also the state insurance guarantee associations. For an insurance company to operate in a state, they must pay into this big state guarantee fund that helps protect clients against, or helps protect insureds against any one insurance company's inability to pay claims. And each, for state specifics, the www.nolhga.com website is a good one, or you can just Google New Jersey, Ohio State Guarantee Fund, and you can find that. Each state is a little different in the amount of coverage that it covers on life insurance, death benefits, the cash values, disability payments, long-term care payments. And what's important to note is that the coverage pertains to the insured per insurance company. So if I had $80 million with one insurance company, then obviously all $80 million isn't covered under the $300,000 there. But if I had three $300,000 policies with 3 different companies, those are all covered separately. And I had just one more question. How are the immediate annuities taxed to the beneficiaries? In the case of the installment refund and the cash refund, because it's still a return of initial premium, there's no gains in that, those would still be income tax-free. With the period certain, it just depends on how much of each payment is considered return of premium and gains. So this is the end. We talked about the claims time, what happens at claims for disability insurance, long-term care insurance, life insurance, and annuities. Now, our 2014 webinar schedule is up. It is on our website, And so you can go to llis.com, education, low load on the road, and we'll be doing some fun things next year. So thank you all for having attended and listened to it, audience, for 2013. Just a few spots remain for our LLIF Insurance Academy in February, and for where most of you all are, I certainly hope it will be warmer here. It's a great time to come to Florida, learn about insurance, and hopefully to see all of you here. And for those of you who have already signed up, thank you for attending. Watch for our annual LLIF e-holiday greeting coming out on the 19th. We've gotten quite a few laughs about it here at our office, so I think it will be fun for all of you. If you're not in our database and would like to make sure you're included, feel free to email me. I just had a question. Does the got confused. Somebody asked, does the Insurance Academy count for CFP credits? And yes, 10 to 12 CFP hours for that 1.5 days. Our academy is, or our webinars are available on the website, the list of what we're going to be covering next year. What are the top 10 things that make low-load insurance services different? Well, we're not your competition. We only work with fee-only advisors. We do a lot of pre-underwriting to avoid surprises. We do our best to save you time and your clients money. And we provide advisor education like this webinar that you just attended. Our advisor tools on our website is another wealth of information for all things insurance. There's our Academy logo. We proudly sponsor NAPFA as a resource partner, the Alliance of Cambridge Advisors, the Garrett Planning Network. We've been I guess it's the national sponsor of the NAPFA Genesis Group, and have had a really good time getting to meet a lot of younger planners starting off and starting to work at many of your firms. We have product specialists in life, disability, long-term care, annuities, and we're all salaried employees here at Low Load Insurance Services. We keep you in the loop with our application information message emails just to keep you advised as to the status of your clients' applications if they move forward with life insurance or disability insurance, long-term care insurance. One of the things that we've added to our quiver of tools to assist you as financial advisors are advanced premium email and notification of term expiration, or as we call them, our APE and our note. The APE is designed to keep you and your clients, give you a gentle reminder that you probably have a premium payment, or you'll have a premium payment coming due in the next few weeks. Make sure to watch for it. It's just something that we can do to prevent any accidental lapses in coverage, and so we do our best to keep everyone in the loop there. Our notification of term expiration, if your clients have a term policy that's coming to the end of the term period or to the end of the conversion period, we're following up with you and your client just to make sure that if somebody needs something different, to take a look at that. I had another question. If you have clients who haven't yet completed their estate planning, will, or trust, and they're in the process of purchasing life insurance, have one child, how should they handle the contingent beneficiary designation? Until they have a will, what I would probably do is whoever would be the guardian. May not be the best thing to do for, a guardian may not be exactly who you'd want to have the money, but I think, basically at that point, if mom and dad are gone, the money should go to the children. Who will be caring for the children is probably, to me, the best idea. And then hopefully then they do finally get the will and trust set up, and then when they have that will set up, then they can change the name of the contingent beneficiary to the trust under my will. If the guardian is a sister, you know, that's probably a really good backup. Now, for those of you, I don't think anybody told me this was going to be in there. This was from our holiday picture last year. And so I think our one on the 19th will be just as fun, probably just as embarrassing to me, maybe not as embarrassing to everybody else. So thank you for attending. Who said insurance isn't fun? Heck, we put on tutus. And oh, thank you for the nice comments about how I look in my tutu. And so thank you all. There are a couple questions that came over that we'll get back with on emails individually. And if anybody has any other questions, I'd be happy to answer them. Or let's see, Jennifer, you've raised your hand, and can you? I just unmuted you, so would you like to ask a question?
No, thank you. You answered it later on.
Oh, okay, great, perfect. All right, I don't see any other questions, so thank you everybody for attending, and I will see all of you, or you will hear, all of you will hear me in 2014. I hope everybody has a great end of the year, and Happy New Year.